This is a chart of the cumulative fiscal deficit from the start of the recession, of all the recessions that I mentioned earlier since 1980. And you'll see the top four lines are the four recessions that preceded this one. I'm sorry, the five recessions that preceded this one. And the black line is if you added up all those together. Remarkably, the red line is what we're doing in 2020 and 21. Again, the boldness of what they did in the beginning of that chart, when you say first 5 or 6 or 7 months, makes a lot of sense. But what's very surprising is we're continuing to double down on these policies, even after it's quite apparent you've had a very strong recovery in the economy. The Fed's easy money will also top a similar amount, almost two times all previous Fed incursions into money printing. Now, what we have observed in recent months is the sharpest recovery from any downturn in recent history. Despite losing 11 million net jobs during 2020, personal income grew at the fastest rate it has grown in 20 years. Think about that. While 11 million people were losing their jobs in a year, we ended the year with the strongest growth in personal income in 20 years. The unemployment rate has recovered 70% of the initial hit in just 6 months. It typically takes 25 months for this to happen. Even after the sharp fall, again, 5 times the average recession, we're already back in terms of GDP to pre-COVID levels in just 5 quarters. The average recession takes 7 quarters, but don't forget, we're coming back from a much deeper hole that was 5 times as deep as that observed in the average recession. It is unnecessary and frankly reckless that 575 billion of the 850 billion in direct transfers of 2.5 trillion of expected QE are being provided after retail sales were above pre-COVID trends and after vaccine confirmation. So if you look at the red line on the chart I have up, that is 2020. I think we can all agree it doesn't look anything like the other recessions, which are more traditional in nature. Much more violent increase in unemployment, and then a huge snapback in a much shorter period of time. I think even moderate voices will agree that the level of support has been excessive. Let me show you how excessive it actually has been. This is a chart of retail sales the last 20 years. They are currently above pre-COVID trend by 15%. Look at the period from 2008 to 2014. It took 6 years to get retail sales back on trend after the great financial crisis. But if you look at the current period, we had a sharp V bottom out, and I mentioned the CARES Act. That's check one. Then we had more fiscal stimulus last fall after vaccines were apparent and after it was apparent that we were in a very unusual recovery. And now, as you know, we've just passed another $1.5 trillion of stimulus when retail sales are 15% above trend. What does that mean exactly? If you took the increase in retail sales from 2016 to 2020 on this chart, that's 3% a year in a recovery. We've just done that in 6 months. We are absolutely booming. We are above trend by, frankly, 5 years in 6 months. Okay. Now let's talk about the Fed's excessive support. The Fed has constantly reminded us that monetary policy acts with long and variable lags. Why then is the Fed still providing emergency financial conditions when the recovery, as I've shown, is in full acceleration? Why are we buying $40 billion of mortgages a month when we are clearly running out of housing supply? Not only is the Fed still providing record amounts of accommodation, it is promising not to raise rates until after 2023, even when the recession is already over. If the Fed raised rates in the first quarter of 2024, as indicated, it will be 41 months after recovering 70% of the drawdown in unemployment. That was the chart I showed with the red line earlier. What do you think the average number of months before the Fed's first hike after a 70% employment recovery is in the post-war period? So it's 41 months that Chairman Powell is predicting. What do you think the average after that kind of recovery has been since World War II? 4 months, 4. And according to the chair, they are not even thinking about ending $120 billion a month of bond purchases. Simply put, the fastest and strongest recovery from any post-war recession is being met with the Fed's easiest response on record, by a mile. Policymakers say we need to go big to avoid downside risks and avoid the stagnation experienced after the great financial crisis. But as I have shown, comparisons with the great financial crisis are completely inappropriate. What about the risks of financial stability? The worst economic periods of the last century have followed the bursting of asset bubbles. Think the 30s after the 29 bubble burst, and think about the great financial crisis after the housing bubble burst. With Dogecoin, which was started as a joke with a $60 billion market cap and NFTs on everything you can spell out there, is there any doubt in anybody's mind that we're in a bubble? Not to mention stock market to GDP is well above any level that we've seen in the past century. More ominously, what about the risk of fiscal dominance and loss of our reserve currency status?